All right, today we're going to break down a Forex strategy that completely flips conventional wisdom on its head. See, it's all about tackling the absolute chaos of the London Open. But the real secret, well, it's not in London at all. It's actually hidden hours earlier in the super quiet Tokyo session. And that right there is the big question, isn't it? How on earth can a quiet, almost boring market session give us a roadmap for one of the most chaotic ones? I mean, it sounds totally backward, right? But believe me, figuring out this little paradox is exactly where you find a real edge. Okay, so first up, the London Open puzzle. Before we even get to the strategy itself, we've got to talk about the problem we're trying to solve. For so many traders out there, the London session is this daily roller coaster of huge opportunity mixed with just as much frustration. I mean, everyone knows London is where the action is, right? That's when the volume just floods in and the market really starts to move. But here's the catch. That same crazy energy creates all these head fakes and false signals. If you don't have a rock-solid plan, it's basically a trap just waiting to snatch your money. So, here is the big idea, the secret sauce, if you will. The key to navigating all that London chaos? You're not going to find it during the London session. Nope. The clues are actually hiding in plain sight during those quiet hours of the Tokyo session right before the storm hits. Okay, so how do we take this cool idea and turn it into something we can actually trade? Let's get into the nitty-gritty and break down the mechanics of this Tokyo failure setup. So what is this thing really? Well, in a nutshell, we're watching the market try to break out of the Tokyo range, and then we're waiting for it to fail spectacularly. That failure, that big rejection, that's our signal. We're literally using a failed move to show us where the smart money is actually going. All right, here's the 5-step playbook. Step 1, you need a nice, tight trading range during the Tokyo session. This basically tells us the market is undecided. Step 2, you got to know your higher time frame bias. Are we generally looking to buy or are we looking to sell? Step 3, now we wait for the trap to be sprung, that false breakout that gets smacked back down. Step 4, we need to see price move aggressively in the other direction, really proving that the first move was a fake out. And finally, step 5, the entry. We're looking to get in when the price pulls back to the 50% level of that original Tokyo range. That's our new battle line. Okay, theory is great, but let's see how this actually plays out on a real chart. We're going to walk through a bearish case study right now. Okay, check this out. We're looking at a Euro USD chart. See that yellow box? That's our tight Tokyo range. Step 1, check. The market is just chilling. At the same time, looking at the bigger picture, we've already decided we have a bearish bias. Price is trading below a key level, so we're thinking short. Step 2, done. And here it comes, the trap. Look there at point 3. Price shoots up and out of the range. This is designed to suck in all the eager breakout buyers. But then, look what happens. It just completely fails. The price gets slammed back down, and it doesn't just re-enter the range, it crashes right through the bottom at point 4. That's our failed breakout and the aggressive reversal we were waiting for. And this is the last piece of the puzzle. After that big drop, price patiently pulls back right to our sweet spot. That 50% level of the original range, you see it there at 0.5. That's our signal to get ready. And then, bam, that strong bearish candle at 0.6 is the final confirmation we need. That's our cue to hit the sell button. Look, finding a great setup is awesome, but it's only half the battle. Knowing when to keep your hands in your pockets is just as critical, if not more so. So let's talk about the rules for the road. Basically, when you should absolutely not be trading this strategy. And this is super important. This is not a strategy you can use every single day. If the Tokyo session itself was really choppy and volatile, forget about it. If the higher time frame chart is just going sideways with no clear direction, stay on the sidelines. And for goodness sake, never take a trade blindly. If you look at the chart and there just isn't enough space to hit a reasonable profit target, you have to pass. The trade just isn't worth the risk. Okay, everyone lean in for this one, because this might be the most important takeaway of the whole explainer. The source material couldn't be clearer about this. This strategy is not a holy grail. It is a very specific tool for a very specific market condition. If you try to force trades or you start overtrading this setup, you're going to kill its statistical edge. And worse, you're going to kill your account. All right, to wrap things up, let's go over a couple of pro tips that will really help you get the most out of this setup. Before you even think about clicking that buy or sell button, you have to do one thing every single time, and that is confirm your risk to reward ratio. Is the potential profit big enough to justify the risk you're about to take? If the answer is no, then the trade is a no-go. Simple as that. And the source gives us a hard and fast rule on this. You should only be taking trades where your potential reward is at least 3 times bigger than your risk. If a setup doesn't offer you at least a 3-to-1 payout, you walk away. End of story. Now, here's a really powerful way to think about losses. When your stop loss gets hit, try not to see it as just a loss. Think of it as new information the market is giving you for free. It could be telling you that your initial idea was wrong, or maybe that the market conditions for the day have just completely changed. And that really leaves us with one final thought to chew on. This whole strategy is built around something that looks like a failure, a failed breakout. And it kind of makes you wonder, right? What other things in the market that we write off as failures are actually powerful opportunities just waiting in disguise?